Welcome to the LA Real Estate Podcast. I'm your host, Sara Skelton, coming to you from the office in my house. We aren't able to record at the studio with the stay-at-home order, so we're doing the best we can to record over the internet. So let's see how it goes. I hope the sound quality is good for you. The whole episode is going to be a discussion with our great friend, Natalie Salins, on how the current situation affects mortgages and how it's changed the real estate market. I know things have shifted dramatically right now, so I really wanted to get to you and talk about this while it's happening. And we'll also answer all of your questions about what you should do if you have a mortgage and maybe you've lost your job or you don't have the money right now to pay your mortgage. If you're thinking about deferring, if you're thinking about refinancing, what that means. We're going to discuss all of that on the show today. We hope it's going to be helpful to you, and we hope you enjoy it. Hi, Natalie. How are you holding up?
Okay. How are you? How are you handling having children in the house all day long?
Well, it's actually, shockingly, it's harder than you would expect. You would think that being in your house 24/7 with a 6 and an 8-year-old little boy would be nothing but joy and rainbows and unicorns, but it's been challenging. It's challenging to get them on both at the same time doing different schoolwork. You know, Henry's a little bit younger. He's in the first grade. So his tasks and attention span is a little bit lower than my other son. And they're both doing this math at the same time, but different assignments and trying to keep track of the assignments. For Tommy's class, he has 5 different websites that they're incorporating into the distance learning, which is a little ridiculous. And every time you click on a link, it doesn't work. So we're spending a lot of time trying to troubleshoot the technology because they're sort of trying to figure it out. So yeah, we're getting by, but we're all healthy and the kids are, really enjoying all the one-on-one, and we're making, but I made Chilean sea bass last night. What else am I going to do with my time? Yeah, it was actually amazing.
I've been loving Blue Apron. I get the Blue Apron meals.
Oh,
it's phenomenal.
That's great.
Yeah, it's fun and simple and incredible meals. Great quality, not expensive. I love it.
Yeah. And we did Blue Apron quite a while ago, and maybe you should try that again just for something different. So Natalie, obviously this is a very strange time. If you would have told me a month ago that we would be stuck in our house, not able to go out without wearing a mask, most businesses closed, schools closed, real estate really at a very strong standstill, a stay-at-home order. It's just a really unusual, crazy time. And I am so excited that you were able to join me today virtually so we can talk a little about what this means for someone who wants to buy a house, someone that owns a house and has a mortgage. So first of all, I'm just really curious about what is happening right now with you. Is anyone buying through you right now? Are people getting loans right now? Or is that sort of just completely paused?
So it's kind of the same thing because, of course, we deal with buyers. So when it first happened and the market kind of crashed and all of a sudden it was in the States and we weren't sure if we were even calling it a pandemic or what it was, I had a lot of cancellations. So a lot of buyers kind of backed out. They got scared and they saw a lot of their money, kind of shifting. So that happened. And then as the stay-at-home orders came into play, less buyers, of course, even less new introductions because people are kind of holding, less, just less interest overall. I have a few escrows still going on, a few purchases coming in. A couple of the people that canceled are now finding other homes and getting back into escrow. So things are still moving. I still have a little bit of business in the purchase world happening. But it's it's like turned upside down for me. Whereas 90% of my business is normally purchase, 10% refi. It feels almost right now that like 80 to 90% is refi, and just a small 10 to 15% probably is purchase.
Oh, wow. And is a big part. So obviously people are, changing their mind. Someone who maybe opened escrow right before this happened, and it's just such an unpredictable time. Are you finding, is people's fear more based in losing a big part of their down payment through the stock market? Or do you think they're just more worried about what's going to happen with house prices?
I think it's a little bit of both. Legitimately, I had people who lost quite a bit of money in the stock market. And even though they didn't cancel, we shifted their down payment amount when we were in escrow. So they were going to put 20% down and we did it 15, or they were going to do 25 and we did 20. So a few people just shifted the amount of money down that they were putting. I think they felt more comfortable keeping cash in the bank than putting it as a down payment.
Right.
And of course, we always have those options available.
Well, and a lot of people are out of work right now.
Yes. And a lot of people are out of work right now. Actually, a bunch of the refis that I'm doing, I'm setting up as kind of building in 2 mortgage payments into the refinance, because you can do that. So people refinancing now, I'm specifically holding to close them until May, and I can build in their May 1st and June 1st mortgage payment.
Oh,
so that
interesting.
They alleviate themselves from having to pay 2 months, and we can just put that payment into the account. So I'm doing that with a lot of people because they just feel more comfortable knowing that they don't have to pay their mortgage till July 1st.
Here's a question for you. Now, I know a lot of people have heard through the media that you're able to, a lot of banks, so when you get your mortgage, sometimes it's sold on the secondary market to a major bank. So sometimes you get a mortgage and then 4 months later you get a letter saying, oh, your loan is now with Bank of America, or your loan is now with Chase. So someone finds out through the media, hey, I can call Chase or I can call Bank of America and I can pause my mortgage payment for 3 months. Now that sounds great, but can you tell me if there's, what the negative to that is?
Sure, absolutely. So as we kind of chatted a little bit before, the media did not do a good job of explaining what the implications are of this and going into what we call deferment, or what will actually be on your credit report as forbearance. That's what happens when you decide to just stop paying your mortgage. You are allowed now to hold on mortgage payments for 3 to 6 months even. There's different options with different servicers. But that doesn't mean that there, like I said, aren't implications. And forbearance does not mean forgiveness. You still have to pay the mortgage.
So do they come as a balloon payment at the end of the 3 to 6 months, or is it usually tacked on to the end of the loan?
It's not tacked on to the end of the loan, actually. You would think that that's how they would do it. They would just pause the payments, and then when you pick it back up, you just have that many months left to pay. Mm-hmm. But servicers need the money. They can't just lose that money because they still have to pay their investors, even though our borrowers or our owners of the properties aren't paying. So, they want that money back as quickly as they can.
And then also we spoke about how, and I know this is something that a few people are really shocked about right now, is that they've chosen to, pause their mortgage payments, and because just so they can have extra money in the bank in case they get laid off, just as extra savings, and then going to refinance to take advantage of these crazy rates and finding out now they can't.
Correct. Yeah. If you're going to tell a bank that you can't pay your mortgage, the bank's not going to give you a new one.
Right.
They're not going to be like, oh, you can't pay? Oh, sure. Let's get you a lower rate. And, that is a little bit in the old days what we called a modification, but that's a totally different story. And that does hurt your credit. I wouldn't go into that unless it was very, very necessary.
And is that is that different guidelines for every bank, basically? Do you think some small credit union, if you had an amazing relationship with them, you might be able to still refinance?
So there's different servicers for sure have different guidelines and are offering different programs. I think if you're in a proprietary bank like a credit union, maybe they won't mind if you have mortgage rates within 1 year. But Fannie and Freddie and standard conforming loans, you're not supposed to have a mortgage rate within the past year. I have gotten away with having mortgage rates in the past year. If the file is very, very strong, I'll still get an approval on it. But in this case, I don't know what's going to happen because it's still also new. I still haven't pulled a credit yet and seen a forbearance. I haven't seen that yet. So we have to, take it day by day. I know that for a lot of files, depending on the equity, depending on the credit, if there is forbearance writing on there, you have to wait 12 months before you can do it.
And then obviously, if it affects your credit score, you don't know how long it'll affect it. That also could affect your rate.
Well, of course. Supposedly, it's not going to affect the credit score. Like, there won't be any derogatories listed on the report, but just the wording of forbearance taken.
Oh, well, that's a positive that it's not going to.
It's not supposed to. That's what they're saying, that they are, FHA came out and said that they are not going to go into foreclosure no matter what on any of their files, that people are not making their mortgages. Because here's what happens. So for some servicers, and you must find out what plan you are on. For some servicers, if you say, hey, I'm not going to pay my mortgage for 3 months, they can come back to you and say, fine, but then you have 3 months to pay all of that money back. Mm-hmm. And they prorate it. So if your mortgage is $3,000 a month, you now have to pay back $9,000 within 3 months. So that's $3,000 extra per month that you have to pay with your mortgage when you get back on it.
I think a lot of people are thinking, hey, I'll just, not pay my mortgage. I've got this opportunity and not realizing then now you have a jumbo payment. And what if you lose your job? I mean, really, I think if you possibly can, pay your mortgage.
Yes, please. Because also it's hurting the servicers, which is making them not want to buy loans. And then not wanting to buy loans is making it harder for me to give them to people who need them and to do purchases.
Can you explain to everyone listening, when you say servicer, what do you mean by that?
The servicer is the person who handles your mortgage payments.
So for example, you
close. Go ahead.
Right. So I was going to say, so when you close your loan, you might have used a loan broker. You might have used someone wonderful like Natalie from Movement Mortgage, and your mortgage might be with Movement, or it might be sold on the secondary market, like I said earlier, and now you're with one of the bigger banks. So that would be the person basically sending you the mortgage statement as your servicer.
Correct. Yeah. It's just the person who handles the mortgage payments and, your taxes and insurance if you have an impound account.
That's another question is it a good time to refinance? So say you're still working, say you maybe bought 2 or 3 years ago, rates were quite a bit higher. You don't have any weird shift in your finances. Should people still consider refinancing right now?
Absolutely. I locked somebody yesterday at 3.12.
What?
Yeah. I mean, absolutely. If it makes sense for you, right? Like, I have a lot of people coming who are like at 3.5, 3.6 that we just closed a few months ago. And they're like, let's refi. And I'm like, okay. I mean, it could make sense if it's a very large loan to refi into the lower rate. But honestly, actually, jumbo rates aren't fabulous for refis right now.
What are the typical closing costs for a refinance versus a purchase?
Refinances are normally a standard, or somewhere around $3,400 to $3,600 for refis, because you pay, a lender fee, escrow fee, title fee, just for recording and stuff. On purchases, we like to say they're anywhere between 1.5% to 2% of the purchase price.
Now, what about
purchases much higher? What
about cash out refis? Are those around the same approximate cost? And then also, are they getting a similar rate, or is the rate higher for that? Because some people might want to pull money out right now.
Yeah. Rates are higher on cash out refis if you don't have a lot of equity. So on cash out refis, it all depends on the value of the property. If you have a ton of equity, the hit to the rate is small. But because, the more money you pull out of the property and the less equity you leave in the property means there's more risk. So with more risk is higher rates.
And that's why if your credit score is lower, your rate is higher because they're taking a risk on you. If you have a lower credit score, you might not be as good at paying your bills consistently. So more risk, higher rate.
More risk, higher rate. It's like anything, right? Like insurance, the more risky you are, the higher your insurance you're going to pay.
Exactly. So what about, now there's a lot of people that have like an investment property, mom and pops, duplex, and they're a landlord. What about refinancing the landlord for a landlord, refinancing a property?
Investment properties? Yeah. Absolutely, if it makes sense. Yeah.
And then what about partial payments? If somebody say, maybe is unemployed now and they're getting unemployment, but their expenses are more than that. What about making partial payments? Does that make any sense?
Yeah, it's great if you can. I think it still goes into forbearance. You have to talk with your servicer. I think even if you pay half, because it's just not the whole thing, it changes the whole amortization schedule. So I think they either stop you and they put you on forbearance or you pay the whole thing.
And now what if somebody, really great financials right now, they're still working, would they be able to buy an investment property right now, especially with, possibly this summer? I mean, we might get a flood of inventory, of pent up inventory that people haven't been able to sell, while the stay at home, or haven't wanted to sell while the stay at home order is in effect. And then we get a bunch of inventory. It might be a good time for investors to pick up properties, even, as one investment property or a duplex or, do you think financing will be available for that?
Absolutely. We still have financing available for it now. The guidelines got a little bit more strict. You have to have a higher credit score. But the down payment's the same. It's always been kind of high, 20% down on single family, 25% down on units for investment. We do have 15% down on investment properties, but the mortgage insurance is unbelievably high. So I always suggest the 20% down.
So it probably doesn't make sense. It's better to wait and just save a little more.
Yeah. For investment.
Can you explain to everybody what non-conforming loans are? And I know we've spoken about this in the past, but for anyone curious about what is a non-conforming loan?
Sure. Non-conforming loan means jumbo, basically. So not a conventional loan, which is kind of through Fannie and Freddie. In Los Angeles County, that loan limit in 2020 is $765,000.
And that's the loan amount, not the purchase price, but the loan amount.
Correct. That is the loan amount. So you can purchase up to, $850 this year with only 10% down and still be conforming.
So if you're getting into a non-conforming loan, with this chaos in the world, what's happening with non-conforming loans right now? Are they still available?
It's a very good question. They are still available, but a lot of guidelines and a lot of investors have gone away. So they're more strict. You have to have a lot more reserves, higher credit. I lost like 10 investors for my jumbo loans.
Wow.
Yeah. And we're not saying lost, actually. That's not a right way to describe it. We're saying suspended. It's suspended at this point. It's paused, waiting for it to come back. Yeah. Because everybody's kind of taking a breath. Nobody wants to give $2 million and have that person lose their job.
Right. And I think everybody is just trying to figure this out right now. I mean, yes, in 2008, 2009, we had the big housing crisis, but this isn't a housing crisis. This is a health crisis.
Mm-hmm. And so it's different.
Right. I've never experienced anything like this in my lifetime.
I don't think anyone has, right? Like my mother, who's in her late 60s, has never experienced anything like this. I mean, it's a health crisis. And I actually have a cool chart of the past 6 recessions in America. Only 2 of them did housing prices drop in. Only 2. And one of them was, of course, our housing crisis, where they dropped by like 20 to 25%.
Right.
And then in the 90s, there was a recession that happened that the housing prices and housing market dropped by like 1.9%, very, very little. In all the other recessions, housing prices stayed high and even went up. So it's not, this recession doesn't have to do with housing. It's the reason we are being affected is because of the stay-at-home order.
Exactly. And so what about somebody who wants to buy in the fall, but is currently laid off maybe for 2 or 3 months, and then they go back to work once the stay-at-home order is lifted? Does that affect their ability to get a loan for quite a while? Or is it just, do you think lenders will understand? I mean, the underwriters will understand that it was a temporary situation.
Yeah. As long as they're back to work, we're good. I only need a pay stub before closing. So they can get into escrow and know that they're not even going back to work for 2 weeks, go back to work and get me that one pay stub before we close.
Oh, that's great.
Yeah.
Because I think a lot of people are really worried about that. And again, for example, production jobs, the production industry was booming, and then all of a sudden a complete standstill. And then I think when we open, there's going to be a lot of pent up demand for everything. So people are going to be very busy.
Oh yeah. I feel like open houses are going to be more slammed than we've ever seen them. I mean, well, here's the deal. Maybe, right? We don't know what it's going to look like when we are allowed to, open back up the economy. So It might be that you're not allowed to have more than 8 people in an open house at a time. Right. Or it might be, and everyone's wearing masks. Like, we don't know exactly what the order will be for each type of work environment we have. If people are going to be allowed in offices and maybe only by a certain percentage of people, we don't know.
Right. And really all we can do is sort of guess, and we don't know how long this is going to go on for. And unfortunately, we're also being told there could be a second wave that could be much, much worse. So, I don't want to be the pessimist, but it's reality, and I want to make sure people are prepared. The best thing that my husband and I ever did was buy this house because, with a stay-at-home order, we are stuck, but we're stuck in our own home.
Yeah. And talk about like doing projects in your house. When it's your home, you invest in it.
We just planted a huge garden in the back. That's one thing I'm so incredibly thankful for. And I understand not everybody, has the ability to buy. Some people just don't have enough money, and that's the bottom line. You need money.
Some, like we're still doing 3.5% down. The 0% down program for us did pause, but we're still doing 3.5% down. We're still giving lender credits if you need help towards closing costs. Like all of that's still in play.
Actually, we closed a deal at the end of last year together because we worked a lot together at the end of last year.
Yeah.
Where my client put 3.5% down.
Yeah, easy.
And they didn't think that they'd be able to afford a house. They make great money, but they didn't have, or, they do well. They didn't have a huge down payment. They didn't have family that could lend them money. They were doing it all on their own. And I was so excited for them that they were able to buy a house and their mortgage payment is less than rent.
Yeah. I always say that's the biggest misnomer, that everybody thinks they need a large down payment or need a lot of money to buy a house. And it's simply not true.
And now in a case where someone wants to buy FHA, are the FHA loans still has anything changed with FHA loans?
Good question. Yes, they have. So we used to do FHA to 580. And for us, it tightened up. Before today, as of yesterday, it had tightened up where you need a 640 FICO score. But today, we opened it back up to 620. So for us today, and I know a lot of lenders out there aren't even doing FHA below 660, but Movement did. Our COO got on a big Zoom yesterday and said, we're opening back up our FHA guidelines to 620 and taking the ratios as high as they normally can allow us to go, which is 57. We had, again, paused and only allowed our ratios to go to 50, but we're back up to 57, which means I can qualify you for more. And so we're still doing them. Just the 580 to 620 mark, we're not doing those because those are under different guidelines as well for FHA. they're what we call manual underwrites. Those
so
take
for
on
really low credit scores.
Yeah, for the really low credit. Those aren't quite back yet. But we are still doing them 620. Renovation loans are a little bit funny right now. You need a higher credit and lower debt to income ratios. Same with VA reno. Like there are some things happening with government loans that are a little bit different, but those are kind of few and far between anyway.
And then really quickly, I heard something about, so before when someone bought a condo, we would have to make sure if they had a low down payment and we're going to need an FHA loan, we had to make sure the entire building was an FHA approved building. And I heard something about that changing.
Yes, there's something called spot approvals. Or we're not even really supposed to call them spot approvals. They're AUD, which is approval unit. Like, so they're just approvals on the unit themselves. So we don't need a full condo project approval, which can take much longer, but you can do what we call anyway spot approvals. So individual units that get approved in the complex. There's still quite a few guidelines, and it's still a nice little process to approve it. That's for sure. FHA guidelines are a little bit more strict than conforming guidelines on approving a building. So they're still there, the strict guidelines, but you're just allowed to approve one unit at a time.
Okay, well, that's good. That opens up a lot of inventory.
Especially because you can go to 765. So you can buy 3.5% down on a condo, in West Hollywood, that's $800,000.
That's amazing. And rents are so crazy on that side. Well, Natalie, thank you so much. I know we could probably talk all day, but I also know that you're very busy. So I really appreciate you taking the time to talk a little about what's happening. And, we'll keep everybody posted. I mean, I'll be, checking in with you multiple times in the next month and see what is going to happen in our world because things are shifting so quickly. And yeah, I'm glad you're healthy and
me too.
Keep it on.
Yeah.
And my kids didn't interrupt me once this entire recording session. I think it's because I let them watch TV instead of doing their schoolwork while I'm recording today.
Smart.
Whatever gets you through the day.
No kidding.
Yeah. Well, thanks, Natalie. I really appreciate it.
Absolutely.
And stay safe. I'll talk to you soon.
You too, Sara. Always so good to chat.
Thank you for joining us on another episode of the LA Real Estate Podcast. I'm your host, Sara Skelton. I want to thank my guest, Natalie Salins from Movement Mortgage. And I wanted to thank you for listening. And really, I hope you guys are all okay out there. It's okay to be not okay and do whatever it takes to get through the day. We're all going through a really crazy, shocking change, and it's not easy. So I'm thinking about you all. If you are feeling lonely or you have questions or you just need someone to talk to, reach out to me. We can have a glass of wine over the internet. We can have a virtual happy hour, and I'm happy to do that. So all of my contact information is in the podcast notes. I'd love to hear from you. And also, if you have any tips for just getting through the day, I'd love to hear them, and I can post them on our social media. So stay safe, everyone. We're going to get through this, and I hope you're all healthy and well. We'll catch you on the next episode.